Thanks, Mark, and thanks all for joining us today. As Mark said, my name's Jolon Knight and I am from Hyperion. As you all know, Hyperion are high-quality structural growth managers, and we've been managing growth equities for over 25 years now. Now, we really aim to do that by investing in the highest quality growth companies, both domestically and globally. We want to avoid low growth, low innovation incumbent companies that are generally very sensitive to economic growth. We're also avoiding early stage startups, fads and momentum companies. But what we're really trying to look for are new world companies that are highly innovative in their respective fields, have a lot of pricing power and effectively are natural monopolies. And more importantly, they're growing by taking market share. Because if you can grow by taking market share, you can effectively grow in any type of economic environment. Now let's start off by having a quick look at the relationship between growth, inflation, interest rates, and ultimately valuations. Now, the inflationary pulse that we've seen from the COVID-19 pandemic is effectively breaking down, and it broke down both in the US and a little bit later in Australia in around July last year. And we'd expect to continue to see that trend continue, although there may be a little bit of wiggle in the tail as there's some lagging indicators that will flow through. But that's really led through into a period of a lot more stability in the US 10-year bond yields, and also here domestically with the Australian 10-year bond yields. And that's been really important. That stability has allowed confidence to come back into duration assets. And what we've seen from that is, PEs start to expand. Now, ultimately, what we expect to see is, a return to a lower growth, low inflation, and low rate environment. But in the long run, it doesn't really matter overly where those rates land, because the sensitivity of our portfolio over 10 years isn't that high to where interest rates are. But even now, where we are at 400 basis points, we've effectively been rebased, and earnings are allowed to shine through. And that's the real key driver for portfolio returns, are underlying earnings. And it's no real surprise to anyone that last year was a really horrible year. And the global portfolio wasn't immune to the moves from the really, really sharp increase in US bond yields. And you can see the inverted US 10-year bond yields there in the blue, and the correlation of our global fund with that. But that correlation has now effectively broken down. And that broke down, interestingly enough, in around July last year, whereas we saw on the previous slides where the inflationary pulse started to roll off, inflation peaked and came down. And our portfolio is now starting to be valued on the underlying earnings growth that it's being able to produce. Now, for us at Hyperion, we always had the assumption and the belief that our portfolio would rebound strongly once inflation started to subside, and we'd start to see some of that stability in those US bond yields. And that's effectively what's happened this calendar year to date, where we've been able to produce over 60% returns this calendar year so far. Now, we like to talk about long-term signalling and short-term noise in Hyperion. And now we all invest in equities for long-term compounding, which happens over long periods of time, but we often get sucked into the short-term noise in markets. And we really want to try to avoid that. And we do that by a few things, by keeping a keen eye on the long-term signals of what our portfolio is able to produce. And that comes through a few different avenues, through the company results and reporting of their financials, and also the industry work that we do. And with that, there's two key inefficiencies that we aim to exploit within markets. The first one's the easiest one to explain, and that's a time arbitrage. And that's effectively just taking a longer term view in the companies that we hold than what the market does. So if you can find a really high quality select few companies that have persistence in sales and earnings growth and are able to maintain higher levels of return on equity over longer periods of time, you can produce what we call as a beat the fade scenario. To give you an example of what that looks like, if we forecast a company out over 10 years to have 15% per annum growth of its sales and earnings, the market might do 1 year 15% growth, year 2 10% growth, year 3 they revert that to the mean, maybe 5 or 6% growth, and if they're lucky enough they might do year 4 or they won't have any numbers there at all. Where if these companies are really, really high quality, they have persistence, earnings and sales growth for multi-decade periods, you can beat that fade scenario and you effectively have a bit of a re-rate and uptick cycle. And we've been doing that successfully both domestically and globally for over 25 years now. The second one, which is a lot more rarer, but can really supercharge your portfolio, is what we call the quality anomaly, or exploiting false narratives. And this really comes down to companies that are doing something really unique, something different, they're innovating really highly, and they're really misunderstood by the market, or they've been misidentified. And the true value of their long-term earnings profile is yet to be seen. Maybe they're doing something like they're investing heavily, they're spending more on R&D, they're a little bit early stage and they're not quite at scale yet. It's very difficult to get a true understanding of these companies, so you have to really do the work. There's no databases on these businesses. You need to go and meet management. You have to have a true understanding of the business that they play in. You have to understand their supply chain. You need to understand the level of utility that they will provide to their underlying customers. And if you can do that successfully, these are the companies that turn into 10, 20, 50, even 100 baggers. Something like a realestate.com here in Australia, a Xero, a WiseTech, or even like a Tesla or an Amazon or a ServiceNow globally. And this is still happening today. And to put this in a bit of more perspective, this is Hyperion's forecast of our global portfolio looking out 5 years versus market consensus. And you can see here on the left, our sales growth, it's not really that far ahead of the market in years 1 and 2. Markets are fairly efficient in years 1 and 2, but when you look out 5 years, we can be anywhere from around 30% ahead on the weighted average, or just under 20% ahead on the median level of the portfolio. But if you push over to the right onto the earnings side of EPS, in 5 years' time, you can be anywhere from around 60% ahead, or on the median level, anywhere from about 30% ahead. And what that means is that you can go through a period of really large upgrade cycles within the companies that you own, if you're right, and that'll lead to a lot of strong positive momentum growth for the share prices in the companies that we own. And for us to have a lot of confidence in the valuations that we put forward and forecast, we can look to the total addressable market for the companies that we own. These are the top 10 holdings of the global fund currently. And you can see, as we stand today, we're only about 3.5% penetrated in their total addressable markets. If we move forward 10 years, we see that growing to around 10%. So even in 10 years' time, with a 10% penetration rate, there is still a very large amount of white space for these companies to grow into. These are multi-decade growth opportunities. Let's have a look at some examples like a Microsoft. It's a very well-known company. It's been around for a very long period of time. It's just under 5% penetrated. They came out at the back end of last year through their Azure business and said that total IT spend is still 90 to 95% on-premise. So that's a real structural tailwind for something like an Azure or an AWS inside of Amazon that'll have multi-decade periods of growth within it. We often talk about selling the future to buy the past as well. You really need to be looking forward and investing in tomorrow's winners, not of the winners of yesterday, as we previously heard. Hyperion has what we like to think is quite a diversified portfolio. We invest in 20 to 25 names, and we diversify that through our 12 structural themes that you can see on the screens here. Now, we also invest with conviction. Our highest weights are around 12.5%. Our top 10 of our portfolio is 70%. Returns, as we are told, do not come in a nice little bell curve. Returns come in the tails. It's a power law. So you need to invest in confidence and invest in the winners. We're often told that it's only the FANG, or now today it's the Magnificent Seven, that are responsible for all returns. That's happened over the last 100 years. When we look back at the data, it is really only the 1 or 2% of companies that are responsible for all returns over and above the cash rate. So we want to invest in that type of a style as well. And for us, we don't want to over-diversify. We don't want to diversify into mediocrity. If you, as asset allocators, have a portfolio of 5 or 6 global managers and they have maybe 40 to 50 stocks within their portfolio, you're effectively getting index-style exposure for active management fees. So we want to have a nice concentrated portfolio where we allocate capital to where we have the highest risk-adjusted returns within our portfolio on our valuations, and really try to drive our returns that way. Now, there's been a lot of talk about AI and machine learning over the last quarter, and it's been a nice little narrative shift as well to get away from that horrible macroeconomic noise that we've had for the last 18 months. But really for us, Artificial intelligence and machine learning really is just bringing software closer to the core of businesses, and that's been happening for over a decade, both domestically and globally as well. And we think there's going to be three key benefits from AI and ML. The first of which will just be the productivity benefits that you will get from being able to run your business smarter, harder, and faster. Maybe you've got some coders that are in your business. One guy codes, the other person checks the codes. If you have an AI machine learning bot that sits off the side, they can check that for him. And you don't need that person anymore. They can do something else, or he doesn't get employed. The second of which might be those incremental revenue opportunities, being able to monetize your customer base more. Microsoft came out, again, they said with their Copilot product, they'll be able to get incremental revenue increases. ServiceNow already has a customer service bot that's been used very well, and it can't be identified as a bot, they think as a person. Workday as well has thrown out a lot of machine learning within their HR product. We're seeing it domestically here in Australia as well. Machine learning has been core at Xero for many, many years. And when you're actually embedded within those businesses, there is no cost of acquisition for that customer, which leads to the third point. Your competitive advantage within that business becomes stronger and stronger, so the risk of you being shaken out becomes less and less. And that's some really positive signs that we like to see coming forward. And this is a multi-decade opportunity. We're still in its infancy. Now, the global portfolio's had a tremendous year to date. We're up about 60%, as I said earlier. That's really been driven by a lot of operational efficiencies that we're starting to see flow through in our companies. We're starting to see right-sizing of businesses. There's been a lot of reduction in headcount. Companies are taking a keener focus on their earnings, not just their top-line growth. And we expect to see that continue, not just in this quarter, next quarter, and through into next year. The internal rate of return of our portfolio is still above its long-term run averages of around 23% per annum. Long-run average is about 17% per annum. So there's still a lot of value left in our portfolio, not just for this year, but for multi-decades ahead. Now, the bottom line for growth equities, the relationship between growth, inflation, interest rates, and valuations, as we saw earlier, inflation has really started to break down. What you do need to remember as well, the one-off moves that you get from interest rates going up or down, or PEs expanding and contracting, are one-off in nature. They do not compound. Earnings do compound. You want to keep a keen eye on the long-term signals. Forget about the short-term noise or the dumb things, as Warren said earlier. And don't sell the future to buy the past. Unless we revert to the world of our grandparents, where we use software less, we use cash more, we stop using our mobile phones or our laptops, high-quality structural growth companies that are innovating are really going to lead the way. And equity returns are always driven by the few, not the many. Back the winners. And to leave you today with one final quote from Benjamin Graham, to be an investor, you need to believe in a better tomorrow. And in Hyperion, tomorrow looks awesome. Thank you.